So it's not like preparing.
Sorry?
It's not like you are preparing the whole thing. It's like parts, bits and pieces.
Yeah, but sometimes that makes it much more difficult even.
Yeah, maybe sometimes.
Yeah. Okay, perfect. Thank you.
Right. So let's welcome ladies and gentlemen to this class whereby we will be dealing with various concepts regarding FAC2602. Please, as we do, feel free to ask any questions. I think I understand that your assessment will be multiple choice. So it's more about understanding the concepts because they will not be asked to prepare everything. But you'll be asked to maybe answer a few questions, some of them theory, and some of them maybe you can be given a scenario, what amount will be shown there and stuff like that. But I don't think it will be much. Right. So the concepts are more important. So we'll do as much as possible. My intention is to make sure that we, number one, we finish the last question, we finish. Then the other question, either we don't do it or we do it, because I think the profit or loss Center of Financial Position, we've done them many times this semester. So that's why I'm not worried much about them. Right. So let's start. The all right. Deck Limited is a company in the entertainment industry, and Cards Limited manufactures gaming equipment and software programs. Deck Limited could not adequately address the increase in demand for gaming equipment. As such, on 1 July 2020, the directors of Deck Limited decided to invest in Cards Limited. The following information relates to the accounting records of Deck Limited and Cards Limited on 31 December 2021. So this is 2021, that's the year end. As a general, you should know that Deck Limited acquired 80% in the ordinary shares of Cards Limited on 1 July 2020, which automatically means that Cards became a subsidiary of Deck Limited. Assume each ordinary share carries one vote and voting rights are undetermined control. The carrying amounts of all the assets and liabilities of Cards Limited were determined to be equal, were deemed to be equal to the fair values at acquisition. The land of Cards Limited at the fair value of 1,500,500 at acquisition date. Cards Limited assessed the fair value of land in the current year to be 2,050,000. This was the only revaluation in the current reporting period, and the revaluation was recorded correctly in the accounting records of Cards Limited. Cards Limited applies the revaluation model to land. The issued share capital of both companies remained unchanged since acquisition date. Furthermore, it is also the group's policy to disclose goodwill at costless impairment in the consolidated financial statements. Goodwill was not impaired in the current year. Right. So generally, this is a subsidiary, and we now know that DEC is the parent and Cards is the subsidiary. Right. Then draft the following pro forma consolidation journal entries of the December DEC Limited Group for the year ended 31 December 2021 after taking the above mentioned information into account. A record of the non-controlling interest in the revaluation surplus for the current year. Right, you should remember that when you acquire a subsidiary, as long as it's not a wholly owned subsidiary, that means as long as you didn't acquire 100% of the shares, part of the shares will belong to what you call the minority shareholders, whom we call the non-controlling interest. The fact that the company acquired 80% of the shares, that means the other 20% belongs to the NCI. Now, if that happens, that means any gains in the subsidiary, 20% of any gains in the subsidiary will belong to the subsidiary. 20% of all the gains in the subsidiary will belong to the subsidiary. So, right. So here we'll have right. Right. We'll have our debit. When we do general entries, we should have our debit and credits. Right. We'll debit our revaluation, surplus, OCI, which is we take the difference because we want the revaluation for the current year. At acquisition, it was 1,500,500, but then to this year, it was the fair value was revalued to 2,050,000. So the revaluation will be the difference between the two. It will be the difference between the two figures. So we'll have that's 2,050,000 minus 1,500,500. What do you get?
549,950.
Is what?
549,950.
549,000.
900. No, wait, mine is my mistake here, sorry.
549, 500.
Yes, sorry, I put my 5 at the
It's
wrong
okay.
place.
Thank you so much. Then we credit what we call non-controlling interest. This will increase the non-controlling interest or NCI in the statement of financial position. Alternatively, the debit, you can say non-controlling interest OCI. It can also be controlling interest OCI. So by saying of sorry, it's not this amount. Sorry. This one is the full amount, remember. But the NCI, their portion only is 20%. Sorry about that. Can you multiply by 20%?
Okay, that makes sense. Yeah.
Remember, 80% belongs to the owners of the parent. Can I just take a motor? Just a second. Right, what did we get?
109,900.
Right, you should also check whether they say narrations are required or not. But anyway, that will not be an issue for you. General narrations are not required, right? Remember, you're doing multiple choice, so that will be given for you. Right, narration is simply a summary of what happened. You can just write recording of non-controlling interest in revaluation surplus. Right. Then number B, elimination of the intra-group profit and the depreciation associated with the sale of machine. Right. Let's go and check the sale of the machine. On 1 August 2020, Cards Limited sold a printer to DEC Limited for a cash consideration of 150,000. On the date of the sale, the printer had a cost price of 200,000 and the carrying amount of 105. We're not worried about the cost price. We're worried about the carrying amount. So the carrying amount was 105, but then it was sold at 150. So it was sold at a profit. It was sold at a profit. It's very important for you to check whether the sale was at a profit or it was at a loss. It is very important for you to check that. Right. So this was at a profit. Right. So we have to eliminate that profit. And another thing, we have to also know whether this was the even if it was sold at a profit or at a loss, whether it was sold during the current year or in the previous years. You have to also know whether it was sold in the current year or in the previous years, because that will also affect our recording there. Right. So here it was in 2020. We're now in 2021. So if it was in 20 and who sold, the seller was Cards sold to DEC. You will see where it works there. Right. So we're going to debit a retained earnings. That's Cards. That is the seller. The difference, which is the selling price 150,000 minus carrying amount 105,000. What do you get?
$45,000.
With what?
45,000.
45,000. Right. My friends, there are about two different scenarios that I want to bring in. I want to bring into account. Right. Then we credit the equipment for the buyer.
Sorry, sir. Why would we bring it in when it's not in the same year?
Remember that the retained earnings, they go over and over. And your equipment, even if you bought, as long as you are still using it.
Okay. Okay, so it's basically just the adjustment of the retained earnings.
Yes, we are adjusting the retained, because the retained earnings will have included that profit. And retained earnings are carried over from one year to another. They accumulate, remember.
So, okay.
So this profit will be included in the retained earnings at the beginning of the year.
Okay, thank you.
Right. My friends, if the sale had happened in the current year, instead of retained earnings, it was going to be profit on sale of equipment. We're going to debit profit on sale of equipment. The credit was not going to change. It was still going to be equipment. Is that right? So that's why I was saying it's important to check, was it this year or last year? If it's this year, it's a profit on sale. If it's last year, it's retained earnings. That's number one. Number two, you have to check, was it sold at a profit or at a loss? If it had been sold at a loss, these journals were going to swap. We're going to debit the equipment and credit retained earnings instead. And if it was this year, it was going to be lost on sale of equipment. Is that fine? Right. So then we have not fully answered the question. Maybe let me put numbers so that when you're alone, you can be able to know where the demarcation with the solution ends and stuff like that. That one was A is done, but B was not yet done. We've answered part of the question. If you see your question is saying a intra-group profit, elimination of intra-group profit, that's what we've done. But it also talks about in the what? Depreciation associated with the sale. We've already dealt with the depreciation. Right now, the depreciation, we have to check how many years were remaining on the date of the sale. Right, we are told that it is the group's policy to provide for depreciation on machinery at 20% per annum.
Sorry, sir, can you just quickly repeat that? I broke up.
Which one?
The part about the depreciation that you just said.
You have to check if the asset is depreciable. So you have to check the remaining useful life or
Okay,
the
thank you.
depreciation policy on the date of the sale. So if they don't give you the 20%, they can give you the depreciation policy. For example, they did they say 20% per annum straight line. Or they could have told you that on the date that the equipment was sold, it had the remaining useful life of 4 years. So then if it's remaining useful life of 4 years, you use the 4 years to calculate the depreciation. Right. Now, I want you to listen to me very carefully here. You debit accumulated depreciation with the total accumulated depreciation. That is the buyer take, which is 45,000 times 20%, then times the total period from the day that the asset was sold until the end of this year. It was sold on 1 August 2020 up to 31 December 2021, our year that we're preparing the financial statements. That means there's 1 year and 5 months. 1 year and 5 months. So that means 17. So multiply by 17, divide by 12. Here we'll be talking about the accumulated depreciation or the depreciation from the date that the asset was bought, sold within the group up to the current year. What do we get?
12,750.
Right. Then we credit retained earnings with the depreciation for the previous years. That is the seller. You would say 45,000 times 20% times 5 over 12. That is the depreciation for 2020. The 5 months in 2020, they will go to retain the earnings because will not be part of the current year's profits. What do we get?
$3,750.
3,750.
Yeah.
Right. Then would they have depreciation? That is the one for the current year. which is 9,000. The depreciation adjustment when the asset is sold at a profit. Right, if this asset had been sold at a loss, they were going to be the opposite. We're going to debit retained earnings and depreciation and credit accumulated depreciation. So this is the second part where they say the elimination of depreciation. The first one is the elimination of the profit. Any questions?
This was now sold in the previous year. If it was sold in the same year, that retained earnings would just swap
And
to
there was
profit.
not going to be any retained earnings. It was just going to be accumulated depreciation and depreciation.
Okay. Oh,
We're
okay.
going to debit accumulated depreciation, credit depreciation. That's it.
Okay.
The retained earnings only comes into play if the sale happened in the previous years. Okay, I'll go to part C. Elimination of unrealized profit included in opening inventory. All right, what is there now? Since acquisition, cards purchase inventory from DEC Limited at a consistent markup on cost of plus 20%. Inventory amounting to 580,000 remained on hand cards records at the end of the previous financial year, of which 30% was purchased from DEC Limited. DEC Limited sold inventory amounting to 1.5 to cards during the current year. Right. Their inventory was 580. We are only interested in the 30% of that inventory which was purchased from DEC Limited. If there is inventory that has been sold within the group and it's still held at the end of the year, we have to eliminate the unrealized profit in that inventory. Only that portion that is still held. Right, so that will be here. If it's opening inventory, we debit retained earnings. Which is by we have got the inventory is 580, but only 30% were purchased from DEC. So times 30%, then multiply by the profit, which is 20, divided by 120. Right, my friends, who is selling here? DEC. You have to be very careful here. If the profit here, if it's markup, if it's a profit on sales instead of on cost, we're not going to say 20 over 120, we're just going to multiply by 20% if it was on cost. If it was on cost, we're going to just multiply by 20%. But because it's on cost, that's why we're multiplying by 20 over 120. So you should be very careful there. Any questions? What do we get?
29,000.
29,000. Then you credit cost of sales. Right. Then so that's it on that one. Right. You should know that there's a difference between the opening and if it was closing, if they'd asked about closing inventory instead of debiting retained earnings and crediting cost of sales. For closing inventory, we debit cost of sales and credit inventory. For closing inventory, we debit cost of sales and credit inventory. That will be the general entry. Like for opening inventory, we're saying the profit will be in the profits of last year. Remember, opening inventory, it means it was sold last year. So the profits were recorded last year. That's why they are being eliminated from the retained earnings. When we eliminate unrealized profit, remember a profit, a retained earnings is a credit. So to eliminate it, we debit it. And this year, the profit is realized because the opening inventory will be sold during the current year. And we credit our cost of sales. When you credit your cost of sales, you'll be reducing your cost of sales. Right. Then elimination of intra-group dividend and recording of non-controlling share in the dividend declared. You go on the dividend total dividend declared by cards in the current year amounted to 75,000, of which 15,000 was allocated to non-controlling interest and 60,000 to DEC. So there's no need for you to calculate. This dividend has not yet been paid. Right. So debit will debit other income or dividends received. That is for DEC. You can use any of the two. 60,000. Then you credit, you debit all non-controlling interest. There will be two debits here. With their share of the dividend, which is 15,000. Then you credit ordinary dividends. Actually, it's unnecessary to write statement of changes in equity. I just wrote, but they don't usually force you to write that. So this is how you eliminate the dividend. Our share will be eliminated from other income because we're saying that is an intra-group income. So that income is to be eliminated. Any questions? Right, that's it on that one, on number one. All right, as I said, I will jump to number 3, since we didn't do much on cash flow. Number 2, just see if we still have time, then we can come back to it. But if we don't, you will have to just do it. Right. Educo Limited is a company that operates in the education sector, providing primary education. The following balances appear in the books of Educo Limited for the financial year ended 30 September. Right. Draft the following sections of the statement of cash flows of Educo Limited according to the indirect method for the year ended 30 September 2020 after adjusting for all entries mentioned above. Right. So we just want to do 2 sections. Our cash flows from operating activities and our cash flows from investing activities. As I said, that I also decided to do the cash flow because I feel that we have done a lot on from the beginning of semester, we're just doing the financial statements. So we've done a lot on that. So that's why I thought that maybe number 2, you can just try to do it on your own, but I should make sure that I do this one here. right? And also the cash flows, we have mainly been dealing with the direct method. So maybe if I deal with the indirect method here, you can also have a feel of the other way. I think you can refer to the recording of our previous class so that you can be able to see how to do the direct method. Right, before we actually answer the question, let's also go through the additional information. Please read your additional information, why it can affect, especially if you're doing a multiple choice. It's very easy to just leave out some additional information. So go through your additional information before you start answering and make sure that you've made the most important pointers. Right. The current year brought some challenges due to COVID-19. Like many companies, Educo Limited also experienced cash flow problems due to various factors. The company decided on a turnaround strategy to maintain operations under the current conditions. The company reviewed its investments and decided to increase investments in financial assets held for trading. These assets are held with the intention of short-term profit making. Right. The fact that, so these financial assets through profit or loss. So here I'm just telling you that some of that increase from the 325 here to the 402 was because they acquired some financial assets. But you should always remember that it's not all increase that can be due to acquisition. They can also increase simply because a change in the price of the share on the market. So you should be very careful then. Then another thing, the fact that they said that these are assets that are held with intention of short-term profit making, that means they will be part of the operating activities. Remember that investment in shares can either fall under investing activities or operating activities. They will fall under investing activities if they are held with a business model to hold them for a very long time. That means we intend to hold them for a very, very long time. That when if they say they are held through other comprehensive income, like in your at this stage, they will say the financial assets are held through other comprehensive income instead of this one here. If you can see, they are at fair value through profit or loss. If they were through other comprehensive income, that could have meant that the business model is to hold them for a long time, so they could have been part of investing activities. So these ones, they are part of operating activities. So you should remember when you do the operating activities to account for this. Right. Then the company obtained a loan amounting to 365,600 on 1 July 2020. Our year is ending 30 September 2020. So that means this year they got a loan of 365 after the settlement of prior year loans. So you should also be very careful that in some prior year loans were also settled. This loan was utilized for both the expansion of buildings and for the acquisition of new technology enhanced equipment. Interest is payable annually in areas and does not qualify for capitalization. Interest for the current year was correctly accounted for, and capital repayments will only start in the next financial year. So they paid interest. Interest is part of the operating activities. Right. And another thing we should remember that this loan was used to expand operations. So this will affect our investing activities. Our cash outflows from investing activities are divided into two categories. We have cash flows to expand operations and cash flows to maintain operations. When we say cash flows to expand operations, we mean we are increasing the size, we are acquiring the assets to increase the size of the organization. For example, you might be opening a new branch in Mamelodi. You are adding more buildings to the ones that you already have. That's expansion. So in this case, this expenditure was for expanding the buildings and also for enhanced equipment. Right. Then when they say investments to maintain operations, that's like replacing. For example, you can have a machine that is damaged and then you buy a new one to replace it. That would be investments to maintain operations. Right, so we should know, so it is very important. This is very important because when we do our investing activities, we should separate investment to maintain and investment to expand operations. All right. Then the company decided to introduce online classes which required technological advancement. The existing computer equipment with an initial cost price of 125,000 was sold at a loss of 10,000 and was replaced with more sophisticated equipment. The carrying value on date of sale amounted to 40,000. Like this one, they are replacing also to maintain operations. Tuition materials are printed and sent to students. An old printing machine originally costing 38,000 was sold for 7,500. All other acquisitions of equipment were to expand the business. Right, included in other expenses are the following balances among its others: impairment loss on financial assets, depreciation, loss on sale of plant and equipment, and then finance cost. And these things, remember, they are supposed, some of them are non-cash items like depreciation. They are not even supposed to be part of the cash flows. And things like loss on sale of plant and equipment, it will affect the investing activities. Whereas things like impairments, loss on financial assets and depreciation and non-cash items. Finance cost is under operating activities, but not part of cash flows from generated from operations. Right. So you shall see how we shall treat them. Number 3, due to the nature of operations under COVID-19, the company entered into a contract with a cleaning company to perform deep cleaning on a weekly basis. The cleaning company was paid in advance for the months of October to December 2020. At the end of the financial year, the total prepaid amount of 45,000 was included in trade receivables. Right. So it's also in trade receivables, there is an amount relating to cleaning services. So we should be very careful there. Right. The dividend declared in the previous financial year was paid in the current financial year. Dividends were also declared in the current financial year. Right. So let's do our extract of the statement of cash flows for the year ended September 2020. Right. Normally we use 2 columns. Right. Normally workings for a heading are done in the first column. Then whatever total for that heading will then go to the second column. Right. But here we're only doing 2 columns. That is the investing and the operating and the investing activities. Right. Right. When you are using the indirect method, you can start from the profit before tax. Right, if it's there, or the profit for the year. But if we simply have the profit before tax, we'll start from the profit before tax. Which is 272,200. Right, then we deal with 2 column adjustments. Right, under adjustments, we have to reverse non-cash items and items that are to be classified elsewhere. When we talk about non-cash items, we're talking about things like depreciation, impairment of assets, financial gain on investments, and financial losses on investments, that is on shares. Then those things have to be reversed. If it's an expense, you have to add it back. If it's a income, you have to subtract it. All right. Then after that, we also have to deal with what we call items to be reclassified. things like interest, dividends, received, those items, they are supposed to be shown elsewhere. So we have to reverse them. Right. So in this case, adjustments that we have, they are given here. Dividend income. Then those items that they said are also included in other expenses, these ones here. We have to what? These items on number 2, we have to add them back to reverse them. Then the dividend income, we have to subtract it. So we're going to say dividend income minus 2,500. Then we go to additional information number 2. Impairment loss. On financial assets. $48,400. Depreciation. $124,450. Loss on sale of plant and equipment. $18,000. Finance cost. $22,584. All adjustments. So they have to be reversed. Right, dividend income and finance costs, who are reversing them because they are supposed to be shown elsewhere under the, but they are still under operating activities, but they are supposed to be shown at a later stage. Impairment loss and depreciation are reversing them because they are non-cash items. Even loss on sale of plant equipment, it's an accounting adjustment, and also it affects the investing activities. So we have to reverse all these items. Right. So we have then we get our profit after adjustments. Right. Then we'll have our movements in working capital. Right, here you analyze your trade and other receivables, trade and other payables, inventory. All those current assets and current liabilities, excluding those to do with interest, tax, we don't include them. Dividends, we don't include them. Right. Inventory. Right, we don't also look at financial assets. Our inventory, it moved from 198 to 250. Right, a increase in inventory, that means they've invested in inventory. So we'll have, so you just be checking the increase or decrease. Increase in inventory. Remember what I said in the previous class, that increase in assets, our assumption that is it will mean that you have invested in inventory, so that will be a minus. Right. decreases in assets, it will mean that you have liquidated your assets. Our assumption would be you have liquidated your assets, it will be a plus. Increases in liabilities, we assume that your creditors have funded you, so it will be a plus. Increases in assets, in liabilities, sorry, that means you have repaid them, so it will be a minus. So here inventory is an asset, and our inventory has increased. That means we've invested in inventory with an outflow. So that will be a 250,300 minus 198,540. What do you get?
$51,760.
51760.
60, yes. 571 551 760 760, yes.
Okay, thank you, Big J. Right. Right, just then. Right, then our trade receivables. It moved from here up to there. They said what here? Due to the nature of operations under COVID-19, the company entered into a contract with the cleaning company to perform deep cleaning on a weekly basis. The cleaning company was paid in advance for the months of October 2020 to December 2020 at the end of the financial year. The total prepaid amount of 45,000 was included in trade receivables. So that means there's a 45,000 which is included here, which should be part of prepaid expenses. So we should take out the 45,000 because it's part of prepaid expenses. Right. Right. So we should take out, so we can say the decrease in trade receivables. Decrease in trade receivables. It was last year, it was $195,500. $800 minus 45,000. Please make sure that when you calculate, you take into account those brackets. The 45,000, we're taking it out from this year because it's supposed to be part of prepaid expenses. Right. When our trade receivables decrease, that means it's an inflow. We're liquidating our receivables. Right. So what do we get?
$45,000.
45,000 is a plus because our assets are decreasing. It can't be 45,000. This one.
Let me just recalculate.
$54,700.
I think that's more like it.
Yeah, I also get that.
Right. Then our prepaid expenses, they are also increasing. Because remember, the 545 will come into this to make it 50,500. So there's an increase in prepaid expenses. Right. We'll have our increase in prepaid expenses. We'll have 5,500 plus 45,000. That 45,000, remember, that was wrongly included in receivables. Minus 1,200. What do we get? And this is an increase in an asset, so it's a minus.
$49,300.
Right. Then we'll have remember, we're just dealing with current assets and current liabilities, except those that have to do with tax, interest, and stuff like that. All right. Then we have trade and other payables from 115 to 159. That's an increase. So increase in trade and other payables, that's a plus. That is 159,390 minus 115,500. What do we get?
$43,890.
43,000.
890.
Right. I think that's all. There's nothing else. We don't include interest, dividends here. So that's it. Then we get cash generated from operations. So this is the only part that is different between the direct and indirect method. Otherwise, everything that we're going to do now will be the same for the direct and indirect method. Right. We're still on the operating activities. Then you then account for your dividends received, dividends paid, tax received, well, tax paid, your interest received, interest paid, purchase and sale of investments that are held for trading. You also deal with them here. Right. So we have got dividends received. Which is the dividends income here, the 2,500. There was no, if you check here on our trial balance, there is no accrual or prepayment for dividends received. We only have for dividends payable here. Right. Then if there was interest received, we're also going to include it, but we don't have interest received. Right. Then we've got interest paid. Now to get your interest paid, my friends, we know that our interest expense were given on number 2. So we take this interest expense on number 2, which is 22,584. Right. Then you add the interest, accrued interest here. The one for last year you add because it means it was paid this year. Then the one for this year you subtract because it means it's still unpaid by year end. So your accrued interest, you add the one for last year, you subtract the one for this year. So that's what we do for accruals. All accruals for last year and subtract for this year. Because we're saying any amount accrued last year, it was paid this year. So we'd say plus 3690 minus 7530. What do we get? And this is interest paid. So if it's a payment, you put it as a minus. If it's a receipt, you put it as a plus.
One 8744.
18764.
744.
7 what?
18744.
4 at the end.
Okay. Right. Thank you, guys. Then we've got the tax paid. You do the same. We take the tax paid here, the tax expense, which is the 272,200. Sorry, the 68050. We add the tax payable for last year, 6,900, and subtract the tax payable for this year. So we'd say 68050 plus 6,900 minus 44,308. What do you get?
$30,320.
Is what?
30,620.
Right. Then we have dividends paid. We do the same again. Dividends declared in the previous year was paid in the current year, whereas dividends were also declared in the current year. So they are simply telling us that the dividends were 28,000. The one for last year were paid in the current year. Right. So that means they paid the 20,000. Acquisition of shares or investments held through profit or loss. Right. On number 1, we're told that the company reviewed its investments and decided to increase its investment in financial assets held for trading. These assets are held for short-term profit making. Right now, these investments, they moved from 325 to 402. And let's not forget that they'd also lost, there was an impairment loss on the financial assets of 48,400. There was an impairment loss of 48,400. Right. So what we do here, we would say, I want you to check how we do that if there's a loss. We would say the value this year, 402, 600 minus 325, 200 minus the loss, which is 48,400. You should be very careful if it was a profit, because the shares can also gain. Instead of subtracting what I did, that 48, we're going to add. All right, what do we get?
$125,800.
125,800.
Yes.
And my friends, as I said, that if they were through other comprehensive income, or if they were not for trading, instead of including them here, we're going to include them under investing activities. But because they are for trading, we are including them here. Right. Then we get net cash inflow from operating activities. We add up right. So that's our operating activities. Any question on the operating activities? Right. Then financing activities. Sorry, investing activities. We first start with investments to expand operations. Remember that we were told that they bought some assets to expand operations on number 1. We told that the company obtained a loan of 365 after settling the prior loans. This loan was utilized for both expansion of buildings and for the acquisition of new technology enhanced equipment. Right. So we have to find out how much did they use them for what. Our land and buildings, if you can see, they moved from 700 to 982. But you should be very careful. Some of the land and buildings can be due to revaluation. So you have to check if there was any revaluation. How do you check if there's any revaluation? You check if there was a movement in the revaluation. Our revaluation last year, it was 150. And this year, it was 225. That means there was a revaluation of about 75,000. So part of the increase of the land and buildings from 700 to 982 was because of revaluation. Right. So we have to find out how much was the portion that was. Remember that we are doing cash flow. We only need the portion that was paid for through cash. Right. We can then say acquisition of land and buildings.
Yes.
Right. I want you to get it properly here. So we'd say the new land and buildings 982,600 minus 700,000. But we take out the portion that was due to revaluation, which was 225,000. So always when you account for the land and buildings, just check if there was revaluation. What do you get?
Two zero seven 600.
What?
207.
207,600.
Double zero.
Like this?
Yes.
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 Okay. Then acquisition of what? Of equipment. Right. From number one, we know that they used for expansion, all in all, they used the 365,600. And we now know the amount that was used on buildings. So the one on new technology, that means we can just find the difference. So that will be 365,600. Because we're told that this loan was used for these two things. So if we know how much was used for the land, then we can be able to find how much was used for the equipment. What do you get?
$158,000.
Right. So this is our investments to expand operations.
Okay.
Our total will be 365,600. Right. Then we've got investment to maintain operations. That is the one for replacement. Right. We were told that the company decided to introduce online classes which required technological advancement. The existing computer equipment with an initial cost price of 125,000 was sold at a loss of 10,000 and was replaced with more sophisticated equipment. The carrying value on the date of the sale amounted to 40,000. Right. So we have to find out how much was the new computer. So they sold one with 125 with a cost of 125. And they also sold one for which had cost 38,000. These are the ones that were given that were sold. Right. Acquisition of equipment. Right. Remember that some of the equipment were bought to expand, which is the 158. So any other increase from here from 450 to there was because of maintaining operations, the new computers that to do with technology, right? But we should remember that some of it was sold. So I want you to be very, very careful here. So we can say 510,000 minus 450,000 minus the one sold, which was which had a cost of 125,000, minus the other one also, which was 38,000, then minus 158,000, the one that was for to expand the operations. The 158 is this one that we calculated. Remember that part of the increase on equipment was due to expansion. What do we get? Actually, let me just remove this here so that you can be able to clearly see them. So we're saying we had equipment of 450 last year. Of that equipment, we sold equipment of 125, that were the old computers, and also an old printing machine which had been bought for 38. We sold them. That's why I removed them, the 125 and 38. So any increase, what? Yes.
I just wanted to find out on that one that it had a cost of 125,000 and was sold at a loss of 10,000. Is that not going to change the price of 125,000?
No, remember that our equipment is recorded at cost. It has nothing to do with selling price.
Oh, okay.
The selling prices will affect the process.
Okay, it makes sense. Thank you, sir.
$65,000.
So that means they bought for 65,000. The equipment to maintain operations. So which is equal to, right? Then we'll have a proceeds from sale of equipment, from sale of computers. I think that's where my sister, that's where you will be answered here. Right? The computers, they were sold at a loss of what? 10,000. Their carrying value was 40. So if the carrying value of 40 and were sold at a loss of 10,000, that means they were sold at 40,000 minus 10,000. Is that right?
Yes.
Which is equal to what? 30,000. This is money coming in, so it will be a plus. Then we have proceeds from sale of old printing machine. An old printing machine with an original cost of 38 was sold for 7,500. All other acquisitions of equipment were to expand the business operation. So it was sold for 7,500. We are already given the amount, so there's no need to calculate. Sold for 7,500. Right. Then we get our net cash flow from investing activities.
Sorry, sir. That on the investment to expand operations, the 207,000. You did that to see what the loan was used for the expansion, correct?
I can't hear you.
The investment to expand operations.
Yes.
The 207,000. You did that to calculate the acquisition of equipment. You did that to calculate the part of the long-term loan that was used.
Yes. Remember that they told that the long-term loan is the one that was used to fund expansion.
Okay, so you just so you calculated what part of the long-term loan is used for that. Okay, thank you.
So how much was used for the buildings and how much was used for the equipment?
Okay, thank you.
Right. So we get is that right? So this is how we calculate. So I just added up this 365, the 65, 30, and the 7. So all in all, there was a net cash outflow from investing activities. Any questions there? Right, my friends, unfortunately I had planned to do the wallpaper with you, but unfortunately because of my power problems, I couldn't do the wallpaper with you. So at your own time, can you just try to also check what you can do on question 2 using whatever we have learned from our previous classes? Then if there are any problems, you can always ask at a later stage. I think I'll be free in the evening.
Thank you very
Very
much.
sorry for the delays and stuff like that. But otherwise, I wish you all the best. But between now and the date, feel free to ask any questions.
Okay, cool. Thank you, sir.
Thank you so much. Have a blessed afternoon.
Same to you.
Thank you,
Bye.
same to you.